A lot of people really, really like taking line breaks, pennant breaks, triangle breaks, wedge breaks in either a continuation or a reversal type situation. How do we increase the odds of success while decreasing the frequency of the trades taken? The way that we're going to do that is we want to use two signals in one. We want to have two setups that strengthen and filter out the signals to give us better probability using protection. And so the way that we're going to look at this is in this example, we see that the market has broken structure and came down and started to consolidate after breaking structure here. So now what we're looking for is, well, where's the entry if this thing breaks? And how does it give us the entry without falsely shaking us out or reversing? Well, what we're going to do is, if we don't have a perfect entry signal while the line is breaking, what we're going to do is we're going to wait until it gives us the signal to trade. In this example, we're going to look at a line break. A lot of people call this a flag, pennant, triangle, wedge. It's all the same. What we want to do is we want to eliminate these false signals on a breakdown or breakout. And the way that we're going to do that is, if we see the crack, in this case, it's a low to low line, we want something greater than, oh, it went through the line. Okay, cool. What we want to do is define the risk that could be less than the risk that's shown in the circle that I've given here. So the first thing we want to notice is we have a breakdown in the market. And so people are anticipating a pullback and a move lower. Now you're seeing it in hindsight, and I want people to see it in hindsight so they can recognize it in the future. But what we want to focus on is, we can't just take a sell signal because it breaks a line, because we have to define the risk first and the probability that it's just going to wick us and go back up. So we want to find the protection first, and then we're going to look at the probability. So if we take a short here about 39.50, 40, your stop is almost 46. If you're comfortable and you have data that shows that you should take this trade, you have an outside engulfing bar that's removing most of the green in front of it. So I'm going to say that it is a good trade, and it happens to be a good trade that wins. Now, for the rest of us that are not going to take a 6-point stop, 7-point stop, what we're going to do is we're going to say, all right, you've showed your hand, prove it, and then I want to jump in. Okay, let's do that. So the way that we're going to look at this is we get the breakdown. So the anticipation of the weak traders that lose money, i.e. the old losing sage, what I'm doing is I'm waiting for a green bar because I want to get green. I want to get long. Ooh, this told me that we're going up, and even though we have this engulfing bar here, we're going to go up on a pullback. I know it. That's how I lost all of my money when I was a losing trader. So knowing now that the losing sage, Rev, is looking for a long, I'm salivating as a professional. What I want to see is I want someone to make a little tiny green bar that I can short when it breaks. I want my GBI as my next setup. So in this case, if you really look, not only do we have two signals saying hello, we've got our third for the confirmation. Let's look. First signal is the line break here. Second signal that you have going on is this is a large outside engulfing bar. That tells you that someone has changed the shift of power from demand to supply. If that is the case, the equilibrium, i.e. price, must shift. So we say, okay, perfect. Show me the stop. I'll show you the entry. Well, magic hands does what they do, and it gives us the absolute perfect bar that clearly defines our stop at 39.25, 39.50, depending on who you are. Take it one tick or two ticks. When we're looking at discretionary trading, what we're doing is we're making a decision. Is the risk of that stop getting hit less than the potential for my target to get filled? Using probability and protection, we find out that the stop's perfect, the entry's proven, that we, over 10,000 trades, X number of them are going to win which is greater than the Y number, which are going to lose. And we're going to execute this trade. And so when I take this trade, I always start to remove risk at my first target, which is 1-to-1 risk reward ratio. Now, some people say, well, how about you go for a larger target? How about you do this? How about you do that? Okay, first thing I want to do is I want to remove risk. Once I'm risk free, I don't care how far my remaining contracts go. I'm going to trade to the next level, right? So my targets in something like this would be either a reversal, okay, or a level that I'm looking for. 100% of the time, we're trading to a level or from a level. Our targets are always to the level if we're from a level. What we do is we wait for our pattern to repeat to a level or from a level all day long. So let's look without even drawing any more lines in here. Let's just look at the way that we would work that. Okay. To a level, from a level to a level. This black dash dot dot is my VWAP, volume weighted average price. So if we get a reversal bar from a level, we're going to the next level. In this case, S1 worked appropriately. You see that they started to reverse it. There's more on the 18s, which is a completely different video. We're not going to get into that, but this is where we would be looking to close. The most important thing is we want to use more than one signal or event to lower the frequency of trades. Most people think, oh, if I can just trade more, I can make more. Meh. Prove that first. What we want to do is lower the frequency and increase the success rate using 2 or more signals or events between locations. I hope that helps, and we'll see you in the room.